Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday. Happy Friday, everyone. And it is February 28th. And welcome to a end of the month here. We got a lot of data to go over on the economic calendar, so let's jump it right in. We'll start off with the personal income for the month of January. So in December, we had a pretty modest number increase at 0.1%. However, forecast was calling for 0.3% in January, and it doubled that to 0.6%. So personal income doubled in January from expectations. And then you got consumer spending in January. So in December, it was up at 0.4%. Forecast is supposed to be a slight downtick to 0.3%. Actually, basically in half. It dropped in half. So consumer spending was less than what expected, but personal income was much more than expected. So overall, not bad news. But of course, we still want consumer spending happening primarily because that's what keeps the economy rolling. And if we see people stop spending, then that means people are going to lose jobs, and then we go into that recession. Let's move on here. We got the inflation data here. This is the Fed's favorite gauge of inflation. It's the personal consumption expenditure, also known as the PCE. In December, it rose 0.3% month over month. Forecast is calling for 0.1% month over month to January, and it rose only 1.1%. Now, if you look at the year over year, it did rise. It went from 1.5% to 1.7%. Now, this is what the Fed looks at as the core inflation or core PCE. And this is when you take out food and energy because those are two variables that we cannot control. So this is what the Fed will look at. And December's month over month was at 0.2%, as you can see right here. Forecast is supposed to maintain that same pace at 0.2%, and however, it only went up 0.1%. However, the core year over year went from 1.5 to 1.6, so it didn't go up as much as the headline number, but it only went 1.6. Now, the Fed wants to maintain a 2% rate, so this is still below the target rate for the Fed on their inflation numbers. Now, to move on here, we have manufacturing in the Chicago region, which gives us the Chicago PMI for the month of February. In January, it was way below. Anything on this number, anything below 50 is in contraction period or pessimism, and then we had anything above 50 or above is expansion or optimism. And as you can see, we're still in contraction period, but we did have an improvement from 42.9 in December to 49 in February. Now, if you recall, earlier in the month, we did see improvement, some pretty drastic improvement in the New York region and Philadelphia region. So manufacturing looks like it's picking up in the month of February. Not quite as much in Chicago region, but in the East Coast, it was looking pretty good. Consumer sentiment also shows some improvements. We had 100.9 in the last reporting. Of course, the February, the forecasts remained the same sentiment, and it has slight improvement to 101. 0.0. So overall, good numbers right here. So, however, stocks are way down again. Dallas, matter of fact, is set to lose more than 4,200 this week. That's a pretty dramatic drop. We're down now to about the 2,500 range when we were already up at like 29,000. Now we're down to like 25,000 and trying to maintain that. And of course, it's all due to the worries about coronavirus that this has been spreading more and more, almost to pandemic levels. This is what's worrying investors about the supply handles, and of course how this is going to affect the economies where people are obviously not going to be spending. If we get everybody in quarantine, somebody's going to be out spending money and stuff and keep things going, and that means we're going to come to a pretty big halt. And at some point, it's not if, it's when, as the CDC had stated, when it's going to hit here in the U.S. More. We're already getting a couple cases, but these seem to be spreading pretty rapidly. For example, in Italy, there was a case. They had 200 at one point. These are round numbers. And then the next day, it doubled that to 400 cases. So these are long incubation periods. They just have no way of really tracking who has these and where they're coming from. And this is what's creating this uncertainty, is creating even more concerns in the markets here. So let's see how this is playing out in the bond market. Bond market is taking off like a gas on a fire here, basically. We're up 61 basis points, exceeding two levels of, as you can see here, we had this floor of ceiling yesterday, we were kind of fighting, and this one, we're already going past it. We're up 61 basis points right now, which definitely gives us a much improvement in our pricing here today in mortgage rates. And as you'll see, yields dropping dramatically down. We're already down to 1.15 right now. We're quickly approaching 1%, and we're right now down about 15 basis points and down to about 1.15 on the yields. We're at all-time lows that we've never been to in these yields right now. So be prepared. If you guys are refinancing, this is a perfect time to check rates. See if you can save some money. If you guys are looking to buy, this is a perfect time. Get into a house because your payment's going to be much lower than what we were like a couple months ago. All right. So if you guys are in California, I'd love to hear from you guys. Reach out to me. Direct message me or email are the two best ways to contact me. Direct messaging, I get it, but it won't be as quick of a response as if you sent an email, and the information's here in the red on this screen here. So go ahead and send me an email, give me your scenario, let's talk, and let's get you guys rolling. All right, you guys have a great rest of your weekend. Enjoy your day, and we'll see you in Monday's video. Thanks for watching. Bye-bye.